Julia, to you first off, Primary, your view in terms of, I suppose, not just this result, but what they're eyeing as far as coming in the next, say, 6-12 months?
Carson, first of all, this is a stock that has rallied 50% over the last 52 weeks, so expectations were quite high going into this result. We have a look at our expectations. We were expecting just under an $80 million result, and instead we've seen just under a $70 million result. It is a strong turnaround from 2011, but 2011 was a year where we did see some strong contraction in patient numbers. And if we look at Primary Healthcare and its business, about 50% of its earnings comes from medical centres. Then we see around about 20% coming from pathology, and then about 12% coming through from imaging. So if we have a look at all of those three key divisions, the biggest division, of course, is the medical centres area. And in terms of EBITDA, we did see an increase of 9% there, but we were expecting to see a stronger turnaround. Margins slightly increased as well by 80 basis points. Pathology, which makes up about 20% of earnings, managed a rise of 13%. In terms of margins, we saw an increase of 100 basis points there, but radiology imaging was really where the standout was, where we saw growth of 30%, and the margins actually increased by 500 basis points or 5%. So altogether, I think the market's going to be a bit disappointed with the results today, especially given that we have seen the shares rallying about 50% over the last year. They have kept guidance for the full year unchanged, so that's a positive. Still expecting EBITDA between $370 to $390 million, and that implies earnings per share growth of between around about 20 to 25%. So yes, we've seen a big turnaround these half-year results, but it does come off a very weak year in 2011 where we did see contraction and the number missing the mark today.
Session today, what's really in your focus?
Well, the two earnings which are in focus today are Primary Healthcare, which has come out with its result, and also REA Group. It does look like it's a better day to come out with results today. The market is expected to be higher, so I think we won't see two big reactions there. In terms of REA Group, this is a company that owns realestate.com.au, and while we have seen, the number of, vendors listing on this going down, what we have seen is revenue and profit has still been quite strong, and that's because premium listings have been quite popular and helped to drive growth. I guess there's a realization that these premium listings on this website has driven more traffic as well as more business, and they have become popular. In fact, the first quarter results were quite impressive. We saw net profit up by 28% and we saw revenue up by 17%. I guess with this stock though, there's two things to consider. First of all, this is a stock that has run extremely hard. In fact, if I bring up a 5-year chart of REA Group, it's a very impressive looking chart. 5 years ago, the stock was around the $4 levels. Now we're seeing it trading above $20. In fact, in the last year alone, we've seen the stock rallying quite hard, up by around about 60%. So altogether, I guess with this one, the valuations are looking stretched, so it really needs to shoot the lights out to continue the rally. It's also in a liquid stock, and that's because News Corporation owns around about a 61% stake in this company. So yes, it's been doing very well. It's the #1 real estate listing site in Australia. However, with the stock rallying around about 60% over the last year, and of course over the last 5 years growing very strongly, it is priced for perfection, and we're expecting to see some strong growth come through today.
Let's get a contrasting view maybe, or do you agree with Peter? Don't touch them.
Well, today's going to be a big day for the retail stocks. As you mentioned, we'll see the retail sales numbers out for December, and this one's going to be watched very closely because in November we actually saw a surprise contraction of 0.1%. So the expectation is that we will see a rebound of 0.3% in December. However, we know that the retailers have been running quite hard. If we have a look at 2013 so far, it's been an extremely positive year. The only discretionary retailer to actually lose ground so far this year is JB Hi-Fi, which is down by about 3%. If you have a look at the others, Myers up by 16% in just over a month, Billabong's up by about 15%, Pacific Brands is up by 14%, even Harvey Norman, which the market doesn't like or hasn't liked too much, is up by 9% in the year to date so far. The discretionary sector, which includes the media as well as the discretionary retailers, very cyclical sector, it's the second best performing in 2013 after information technology, which is driven by those market related stocks like computer shares. So the discretionary sectors up by about 9% in 2013 so far. The retail sales numbers are going to be important for these retailers. They have run quite hard on expectations that we will start to see some of those interest rate cuts start to kick in, and a better cyclical environment for the retailers, even though they are still facing structural challenges. So we are expecting a better cyclical environment, even though the structural challenges remain. retail sales numbers out at 11:30. We'll be watching the retailers for a reaction, as well as that Aussie dollar, which weakened overnight.